The first thing I want to tell you is that moments like this are almost never announced politely. They arrive wearing headlines, fear, urgency, and the false confidence of people who have not done their homework. Right now, a great many investors are staring at war, staring at oil, staring at a market that looks confused, and they are coming to the worst possible conclusion. They are assuming that confusion means stand still. They are assuming that volatility means danger only. They are assuming that the next decade of wealth will be built by the people who panic least elegantly. I do not see it that way. I think this is shaping up to be one of those periods when a patient investor can do extraordinarily well. Not because the world is calm, not because the headlines are kind, but because uncertainty is creating the exact mispricing that fear always creates. I have lived through enough cycles to tell you that the market does not hand out its best opportunities in moments of emotional comfort. It hands them out when people are tired, confused, overexposed to bad news, and desperate for certainty nobody can actually provide. That is where we are. We are several weeks into a war with Iran. Negotiations look chaotic. Policy signals change by the hour. Oil has everyone talking about inflation, recession, stagflation, and the end of the easy money era all over again. Every financial headline is built to make you feel as though the floor is about to disappear beneath your feet. And yet when I step back and look at the setup coldly, I do not see a reason to run. I see a reason to prepare, not to gamble, not to go all in like a fool trying to turn a market swing into a personality trait, to prepare. Because the next 12 months may end up being one of the best wealth building windows of this decade for the investor who understands what kind of game he is actually playing. Most people still think investing is about predicting. They think the winner is the man who can tell them where the SP will be next month, where oil will be next quarter, whether inflation will print hot or cold, or what some politician will say in a press conference next Tuesday morning. That is not investing. That is theater. The serious money is made by understanding how markets behave under pressure, how history tends to rhyme, how bull and bear markets actually differ in magnitude, and how to structure your behavior so that volatility becomes an ally instead of a threat. That is the whole conversation. If you understand nothing else from what I am about to tell you, understand this war introduces uncertainty. Markets hate uncertainty. So the first move is usually fear. But the first move is not the whole move. In fact, the first move is often where the opportunity begins. When this war began, the market sold off exactly the way markets usually do when geopolitics intrudes on a complacent setup. Investors saw headlines, they saw oil spike, they imagined the 1970s, they imagined supply shocks, they imagined a recession, then a deeper recession, then a policy mistake, then a lost decade all before the first month of price action had even finished drawing itself. That is what people do when they let narrative outrun arithmetic. Historically, the first month of war is often where the emotional low is formed. The market gets hit by uncertainty, reprices quickly, and bottoms roughly around that first 30-day window. That is not because there is magic in 30 days. It is because fear tends to be front-loaded, while facts are slow, messy, and less dramatic than the imagination. That is precisely what happened here. We entered the war near prior highs. The market sold off hard. About a month into the conflict, it found its footing. Then it climbed right back toward those old highs. The round trip was fast enough to punish the man who froze, fast enough to reward the man who bought rationally, and loud enough to convince everyone that the easy money had already been made. That last part is what I want you to challenge, because the opportunity in these setups is not confined to one clean dip and one neat recovery. That is the simplification people tell themselves after the fact. In reality, the first 30 days often establish the emotional bottom, but the next 12 months are where the real money is made. Not in a straight line. That is the part that matters. I am not telling you the market now goes from here straight upward. It may not. We may get more drawdowns. We may get sharper corrections. We may even undercut earlier lows. War creates volatility. And volatility does not move politely from left to right in a smooth diagonal. It jerks, it fakes, it scares, it reverses. It punishes the impatient and seduces the undisciplined. But that same volatility is exactly what creates the window. You do not need a market with no fear to build wealth. You need a market with repeated dislocations, a long enough horizon, and the discipline to buy when other people are busy explaining why buying is irresponsible. Now, let me deal with the main fear directly, because this is the engine behind much of the present anxiety. Oil. The argument runs like this. Oil rises, energy costs rise. Higher energy costs lift prices across the economy. Inflation comes back, the Federal Reserve gets trapped, growth slows, unemployment rises, and because inflation stays hot while the economy weakens, we get stagflation. Once the word stagflation enters the conversation, people stop thinking and start hallucinating. The 1970s. I understand the fear. I do not think it deserves the authority people are giving it. The first mistake is confusing a price shock with a sustained monetary condition. Higher oil can absolutely create short-term pressure. It can hurt sentiment, it can raise costs, it can squeeze margins and make consumers miserable. I am not dismissing that. What I am dismissing is the lazy leap from an oil spike to the conclusion that a long and grinding inflation regime is now inevitable. Inflation, the durable kind that corrodes purchasing power year after year, is a monetary phenomenon. It comes from too much money relative to output. Politicians and pundits love to point at whatever visible thing is currently expensive because it makes inflation sound like an accident that happened somewhere else. But if the money supply is not being abused, commodity spikes do not remain a permanent inflation engine on their own. Oil is cyclical that matters at very high prices. Oil creates its own resistance. Demand weakens, businesses cut back, consumers retreat, marginal users disappear. The economy itself starts rationing usage. There is no world in which oil can live at absurdly elevated levels forever while demand behaves as though nothing changed. If oil spikes to levels that sound catastrophic in a headline, that usually contains the seed of its own reversal. So when I hear people say this is the start of a permanent energy-driven inflation spiral, I hear a familiar overreaction. I have heard versions of it before. They always sound intelligent because they are built on a real fear. What they lack is historical humility, and humility is valuable in markets. Now step back from oil for a moment and look at the much more important long-term fact: bull markets last longer than bear markets. Bull markets go farther than bear markets. That is not optimism, that is history. If you study broad market history, what you find is almost embarrassingly simple. The average bull market runs for years and compounds far more than the average bear market destroys. Bear markets are painful, dramatic, and emotionally unforgettable. Bull markets are longer, larger, and so familiar that people stop respecting them. That imbalance is the entire reason long-term investing works. If markets were equally balanced between destruction and recovery, there would be no point. But they are not. The math is asymmetrical in favor of the patient owner. Even if you narrow the lens and look only at the modern period, the pattern survives. Over the last 20 years, the market has spent far more time in bull phases than bear phases. The green stretches have been longer, the gains have been larger, the drawdowns have been violent. Yes, but temporary relative to the scale of the advances that followed. People remember the crisis years because fear is memorable. They forget the compounding years because compounding is quiet. That memory problem is expensive. It leads people to behave as though disaster is the normal state of markets and recovery is the exception, when the opposite is closer to the truth. The bear market is the interruption. The bull market is the larger tendency. This is why so much money is lost waiting for corrections that either never arrive or arrive after years of missed gains. I have watched intelligent people sit in cash, certain that prudence required them to wait. Then the market rose for 3 years without them. When it finally corrected, it corrected from levels far above where they first became cautious. They bought the dip proudly, and still ended up buying higher than where they could have purchased years earlier had they simply accepted that no one rings a bell at the bottom. Waiting feels smart because it flatters the ego. Owning through uncertainty feels ordinary because it demands patience rather than drama. But the money rarely goes to the man performing intelligence. It usually goes to the man quietly following a durable process. That process begins with horizon. If you insist on playing the market over a single day, your odds are poor. If you insist on playing it over a single year, the odds improve, but you are still exposed to substantial randomness. Stretch the horizon to a decade, and something important happens. The probability of a positive outcome becomes overwhelmingly high. That is not because the market is kind, it is because capitalism, despite all its ugliness, tends to reward ownership over time. Businesses adapt. Weak companies die. Stronger ones take their place. Productivity improves. Prices rise. Innovation arrives in lumpy waves. The broad index throws out its losers and absorbs its winners. The patient owner benefits from this constant renewal without needing to predict which boardroom will thrive next. That is why I continue to come back to the same principle. If your time horizon is 10 years and your vehicle is sound, the market becomes less like a casino and more like a mechanism, not a perfect mechanism, a useful one. Now let me connect this directly to war, because this is where many people become theatrical. Every time a war begins, someone announces that this time is different. Every time the phrase should set off an alarm in your mind, because it usually means someone is trying to persuade you that history no longer matters at the exact moment, when history matters most. Look at prior geopolitical crises, look at prior wars, look at prior shocks that felt existential in real time: Iraq, Ukraine, financial crises, pandemics, sovereign scares. Every one of them felt enormous while it was happening. Every one of them produced a flood of competent explanations for why the market could not recover in the usual way. And yet, in case after case, The broad market eventually treated the fear as a buying opportunity, sometimes quickly, sometimes messily. But eventually, the point is not that every war is good news. War is not good news. The point is that the market has repeatedly demonstrated an ability to absorb geopolitical shock, price in catastrophe faster than people expect, and then move higher long before the news cycle gives anyone permission to feel comfortable. That is what frustrates so many investors. They wait for the world to feel safe. The market usually moves first. Since the great financial crisis, the broad U.S. market has climbed through war, through pandemics, through inflation scares, through trade wars, through political chaos, through every variety of expert certainty. If you lay all those events on a long-term chart, the message is almost rude in its simplicity. The market spent years rewarding the owner who stayed in the vehicle, while terrifying the passenger who kept trying to jump out and back in. Now let me make the conversation more practical. The best argument for owning today is not simply that the market always comes back. That phrase is too glib. The better argument is that the market can become more attractive even when the index level looks unchanged. That is exactly the kind of nuance many people miss. An index can sit around the same level it traded at months ago while the underlying valuation becomes meaningfully more reasonable because earnings catch up, sentiment compresses, and forward multiples fall. That means the same price can represent a better long-term deal. That is where we are right now. The broad market is not standing at some wildly more euphoric level than before. In many cases, the multiple investors are paying for the same stream of corporate earnings has come down significantly. In plain English, you are getting the market cheaper without needing to wait for a dramatic collapse in the index itself. That matters because long-term returns are heavily influenced by your starting valuation. If the market was unattractively priced a few months ago and is less demanding now, even without a giant index drawdown, the long-term investor's forward return profile improves. You do not need a cinematic crash to get a better entry. Sometimes you just need fear to do its quiet work beneath the surface, at a more reasonable forward multiple. The next 10 years begin to look a lot healthier than they did at a stretched one. That does not mean there is no downside in the next month. It means the long-term odds have improved while the short-term crowd is still fixated on headlines. And that brings me to one of the most important distinctions in this entire discussion. Do not confuse believing in the long-term opportunity with endorsing mindless buying. Blindly buying the dip is not discipline. It is just another form of emotional behavior wearing a respectable hat. If you take all your capital and throw it into the market in one dramatic gesture because you have convinced yourself the bottom is here, you are not investing. You are gambling on your own ability to declare victory before the market has finished speaking. The market may go lower, it may go much lower. That volatility does not weaken the Durham thesis. It strengthens the case for process. The process I believe in is simple. Own steadily, deploy gradually. Maintain the ability to buy more when fear deepens. Use volatility. Do not worship it. Do not demand that the first purchase be the perfect one. If you buy an index at today's level and the market falls meaningfully, the disciplined investor is not ruined. He becomes more interested. He has a schedule. He has reserved capital. He has already accepted that lower prices are an opportunity, not a personal insult. That is what dollar cost averaging is really about. It is not just a mechanical system for people who dislike thinking. It is an emotional defense mechanism. It keeps you from making a religion out of any single price point. It allows you to participate now while preserving ammunition for later. It recognizes that markets can remain irrational in the short term without altering the long-term logic of ownership. If prices rise from here, you already have exposure. If prices fall from here, you have more to deploy. That is what preparation looks like. Now, I want to make another distinction that matters enormously. Buying a broad market ETF is not the same thing as buying an individual stock. Too many people talk as though these are interchangeable because both happen inside a brokerage account. They are not interchangeable. When you own a broad index fund, you own a self-cleaning machine. Weak companies deteriorate, fall out, and are replaced. Strong companies grow, gain weight, and take up more space. The index does the dirty work for you. It is one of the most elegant structures in finance precisely because it quietly handles the thing most investors are worst at, admitting that a winner can become a loser and acting before sentiment catches up. That means broad index investing allows you to be more process-oriented and less prediction-oriented. Individual stock investing is different. There the burden shifts to you. Now you must identify businesses that can compound through adversity, survive shocks, and emerge stronger. More importantly, you must have the conviction to keep owning them when they fall 40%, 50%, or 70% for reasons that may be temporary but feel permanent in real time. That is a very different skill. Many people like the idea of individual stock returns. Very few like the emotional experience required to earn them. It is easy to brag about wanting the next great company. It is much harder to sit quietly when that same company is down 65%, and every article says the story is broken. If you do not have both judgment and temperament, individual stocks become a way to magnify your own weaknesses. That is why broad market ownership is such a powerful default. It gives you exposure to capitalism without requiring you to be a prophet. If you do choose individual names, then be honest about the standard. You are not looking for good stories. You are looking for genuinely strong businesses with durable economics, sensible capital allocation, real staying power, and enough future runway that time can work for you. Then you need the discipline to buy when they are unwanted, and the discipline to trim when they become overloved. That cycle matters. One of the great mistakes in investing is forgetting that the best time to buy a business is usually when it still looks like a piglet, and the best time to trim it is often when it has become a fat pig the crowd now worships. People reverse the sequence. They buy what is already adored and panic out of what is merely cheap. A broad index handles part of this automatically. Individual portfolios do not. In an individual portfolio, you must manage the arc yourself. You must know whether you are buying strength at a fair price or popularity at a foolish one. And once the position is large and the gains are substantial, you must be capable of reducing risk without turning every trim into a betrayal of the thesis. That is just maturity. Now let me return to the current moment and tell you why I believe the setup is still attractive. We have war-driven uncertainty. We have oil-driven fear. We have valuations that are more reasonable than they were. We have a long-term historical record that overwhelmingly favors ownership, overweighting. We have a market that has already shown its first instinctive sell-off and recovery pattern, reminding you that prices move ahead of emotional permission. We have 12 months ahead that are likely to be volatile enough to frighten the crowd and rewarding enough to benefit the prepared, and we have one more factor that people repeatedly underestimate in times of real uncertainty. Capital still runs toward the United States, not because America is flawless, because there is no comparable alternative with the same scale, liquidity, depth, legal structure, and reserve currency status. Every few years someone explains that another block, another currency, another arrangement is about to replace the dollar and overturn the pecking order. I have heard these stories before. Maybe the distant future looks different. Perhaps it will. But for the investable future most people actually live in, the U.S. market remains the central arena where global fear often goes looking for shelter. That does not mean you should be blind to international opportunity, far from it. But it does mean that betting aggressively against the U.S. system every time headlines get noisy has been, historically, a very poor way to make money. The safer conclusion is this: own the dominant system, diversify intelligently. Keep liquidity. Use fear to your advantage rather than allowing it to use you. Now let me show you what that looks like in plain language. If you are a passive investor, your task is not heroic. It is to keep buying low-cost broad vehicles with discipline and patience. Do it on a schedule. Do it when you feel brilliant. Do it when you feel stupid. Do it when markets are calm and when markets are absurd. Let the machinery work. If you are a more active investor, then your job is harder. You must understand where capital is likely to flow, which sectors benefit from reshoring defense spending, domestic energy, infrastructure, software efficiency, or global reallocation, and which businesses are merely popular slogans. You must know the difference between a temporary markdown and a permanent impairment. That is work. Most people underestimate how much work it is. Then you must answer the second question: what are you actually trying to build? Cash flow appreciation, inflation protection, optionality. Those are not the same objective. If you want current cash flow, you think differently than the man chasing pure capital appreciation. If you want insurance against monetary disorder, you think differently than the man seeking maximum compounding from software or industrial productivity. If you want resilience, you build differently than the man optimizing for excitement. Most people fail here because they buy assets before defining the purpose. Those assets are supposed to serve. That is backwards. Begin with function. Then choose the vehicle stocks, real estate, short duration treasuries, commodities, selective hard assets, and a measured exposure to more speculative instruments. Each play different roles. The mistake is not owning any one of them. The mistake is owning something you cannot explain. If you cannot explain in plain language why you own a position, what outcome it is supposed to serve, and what would make you sell it, then you do not own an investment. You own confusion. Confusion is expensive during volatile periods. Preparation is cheap by comparison. That is why I keep coming back to a simple rule. Do not invest in anything you cannot explain to a bright 12-year. Old complexity is often a sales tool. Clarity is usually a protection mechanism. The man selling you sophistication is often charging you for fog. Now let me put the risks in order. The first risk is the cash trap. This is the quiet one. If you are sitting overwhelmingly in cash because you are frightened, you may feel safe while your purchasing power erodes, your opportunity cost compounds, and better entry points pass through your hands unused. Cash has a role. Dry powder matters. Emergency reserves matter. But beyond a sensible reserve, cash becomes a hiding place that quietly taxes the fearful. The second risk is concentration disguised as patriotism. Many investors think owning U.S. equities means pure domestic exposure. That is not necessarily true. Many of the biggest American companies earn substantial portions of their revenue abroad. That can be a strength. But it also means you should know what you actually own. Revenue exposure matters. Currency exposure matters. Business model resilience matters. It is not enough to know the ticker. You need to know the engine. The third risk is the timing trap. Trying to catch this setup perfectly is how people miss it entirely. The market owes you no perfect entry. If you sit and wait for certainty, you are asking for a thing markets almost never provide at the moment of maximum opportunity. The proper posture is not prediction. It is staged participation with liquidity, patience, and psychological readiness. Buy steadily, buy more aggressively when fear gives you a genuine discount. Do not let your whole strategy depend on one dramatic move. That is not courage, it is vanity. There is something else worth remembering here. Every cycle creates a group of people who later claim the opportunity was obvious. It never feels obvious when you are in it. When the war headlines are live, when oil is rising, when inflation is the only thing anyone can talk about, when social media is full of prophets of doom, the opportunity does not feel like opportunity. It feels like danger. That is why it exists. If it felt comfortable, the crowd would already own it correctly and the returns would be lower. You are being paid for discomfort. That is what the market is offering, not a free lunch, a premium for keeping your head. So what do I think this moment is? In the end, I think it is a test. A test of whether you have learned the oldest lesson in markets, which is that temporary chaos does not usually destroy the value of disciplined ownership. It reveals who actually has discipline and who was merely reciting slogans during easy years. If the market drops from here, your answer matters. Will you freeze? Will you sell? Will you sit in cash waiting for a lower low that may come after years of missed recovery? Or will you already know what you own, why you own it, how much cash you have reserved, what your buying schedule is, what kind of businesses or vehicles deserve more capital, and what kind of decline would justify deploying it? That is the difference between an investor and a spectator. This period may very well become one of the great wealth building windows of the decade, not because everything is healthy, because everything is unstable enough to create repeated mistakes in price. The patient investor lives off those mistakes. He does not need perfection. He does not need the all clear. He does not need to know the exact date of the next move. He needs a sound process, a long horizon, emotional control, and enough humility to let history do more of the work than his ego. That is the playbook. War creates fear. Fear creates volatility. Volatility creates mispricing. Mispricing creates opportunity. Opportunity rewards the prepared. If you want this period to become generational wealth instead of generational regret, then stop asking whether the headlines feel good and start asking whether your system is ready. Because this is not the phase for heroic predictions. It is the phase for disciplined accumulation. It is the phase for buying quality on weakness, for letting broad low-cost vehicles do their quiet work, for using cash as ammunition instead of shelter, for refusing to mistake temporary disorder for permanent impairment, and for remembering that the market has a long history of humiliating the man who waits for emotional comfort before he buys. You do not have to be perfect. You do have to show up correctly. That is enough. And in periods like this, enough is often what builds the fortune.